India Ratings has published the FY23 mid-year outlook on the NBFC and structured finance space. Within this outlook, India Ratings has stated that the focus is on liability management, which is key for maintaining margins and loan growth. To understand what forms the basis of this assessment and much more, stay tuned to this episode of the Expert Lounge. Hi, I'm Siddharth Rego and I have with me Jinay Gala, Associate Director, and Payal Anand, Senior Analyst here at India Ratings to take us through the NBFC and Structured Finance Outlook. Jinay, Payal, welcome to the Expert Lounge.
Thanks, Siddharth.
Thank you, Siddharth.
So I've gone through your report, Jinay, Payal, and what's written within that is the fact that India Ratings sector outlook is neutral for retail NBFCs, HFCs, and wholesale, while the rating outlook is stable across all asset classes. Keeping this in mind, Jinay, I'll pose the first question to you. How do you see NBFC growth kind of playing out across FY23?
Yeah, thanks, Siddharth. So on the NBFC side, what we see, the growth would be normalizing in FY23. That would be going back to the pre-COVID levels. If you see, the NBFCs have navigated 2 years of challenging period in terms of the pandemic, where the growth had taken a backseat. But a lot of NBFCs had done a corporate deleveraging and the deleveraging on the capital side, which could come handy for them, largely for the growth in FY23. As we see that the operating environment has normalized, even the debt funding has become quite adequate in current juncture, and also the asset quality pains are moderating. This would help NBFCs to grow at around 14% CAGR, at least in FY23 and FY24, which we envisage. If there are no other further challenges on the pandemic or any surprise events coming in. Having said that, what we see, there could be some amount of demand pressure coming in because there are inflationary pressures building on the borrower's side, and also with rising interest rates, we see the demand would stand muted. But having said that, again, since there is a festive season which will be kicking in, that could provide some amount of baseline credit growth for the overall sector. But still, what we envisage is that the sector will grow at 14%, which would be again going back to the pre-COVID levels.
Interesting, Jinay. So it would normalize to pre-COVID levels in FY23. You mentioned rising interest rates, Jinay. What do you think is the impact of rising interest rates in terms of the funding mix? What are the trends we are seeing here?
Yeah. So incrementally, the liability management becomes quite crucial for managing your margins and even growth during the rising interest rate scenario. And what we see as a trend is that the NBFCs would largely be going towards banking side, where capital market borrowing would become pricey. And this could also lead to a larger NBFCs gaining funding from the banking side. And this could lead to skewing out effect for the smaller NBFCs, where we see the pressure on the cost of funds could be on the higher side. Also, if you look at last 2 years during the pandemic, the commercial papers was largely the growth on the commercial paper as a funding tool was quite muted. And with pandemic now subsidizing, we see the corporates going back to the commercial funding, commercial paper funding, which could come to around 8 to 9% of the total borrowing mix. This could help them to manage their overall funding cost and remain competitive into the segment. We also see that could be incremental trends which could emerge largely in terms of co-lending, where banks and NBFCs can co-participate in lending to the borrower. And this could be the new theme which could largely be played by the smaller NBFCs, where tying up the funding could be a challenge.
Right, Jinay. Payal, what about you? You look at the securitization market. I pose the same question to you. With interest rates rising, any emerging trends within the funding mix?
Thanks, Siddharth. So in terms of securitization, as we started with this year, we saw that kind of front-end supply and securitization, that is not usually the Q1 of any year. Usually it's very, very low volumes in the Q1. But what we saw this time, there was a funding demand, there was a continued higher funding demand. Originators were trying to lock in yields ahead of any more interest rate hikes. So that was there. And in the second quarter as well, there was a huge demand. But we also saw ahead of any interest rate risk or any interest rate hikes, there were some of the deals which were not closed because of the investor asking for higher yields. So that kind of trend was seen. But the market is there. There's a lot of volumes we have seen as compared to the last year, same quarter. So that kind of volumes are there in the securitization market. And we are seeing this to pan out in the next half as well.
Interesting. Very interesting, Payal. Payal, if I have to look at FY23, maybe break it up into two halves. Uh, how has the securitization market performed in this year till now, and what do you see in the second half?
Yeah, so as I said, in terms of volume and in terms of asset classes also, so volumes has panned out, as I said. In terms of asset classes, there's a lot of traction from the unsecured asset classes as well.
Right.
Talking about personal loans, unsecured business loans, microfinance. These are the asset classes which are coming up again. There's a confidence in terms of investors trying to look at these kind of asset classes. But the trends, if you see, there's a cherry picking of these loans, of course, that is panning out in the pool performances as well.
Okay.
So that is something everyone's very cautious about at this point in time as well. There's a structures where we are seeing that everything's coming out from the pool is going directly to the PTC holders.
Okay.
So nothing is going back to the originator in that sense. So these kind of structures, they are giving more confidence to the investors, and this is something to stay in this year as well, I would say, going ahead.
Right, Payal, right. Jinay, coming back to you, we briefly touched upon the impact of rising interest rates on the funding mix. How do you see the impact on margins going forward?
Yeah. So the margin pressure could be quite selective, where if you look at the NBFCs, immediately would not be passing the rising interest rates to the borrowers, but they would be facing this rising interest rate on their borrowing part. So incrementally, what we see is that certain asset classes like personal loans, unsecured lending, and also in terms of microfinance would be the areas where we see there could be easily pass through in terms of the rising interest rates,
Right.
Which has risen by around 190 basis point on the repo side. But there are certain asset classes where there is a higher amount of competitive intensity, like a large ticket loans and also housing loans, where we see the pass through may not be that easy because of the competitive pressures. Having said that, what we see that incrementally there could be some amount of moderation on balance sheet liquidity, which could help reduce the negative carry which used to be there on the NBFC's PNL, which could also help them to sustain margins.
Okay.
And also in terms of the credit cost, if you look at the credit cost normalizing back to pre-COVID levels would also help and aid the profitability for NBFCs. So definitely there would be some amount of pressure on the margins, but that get negated because on the lower credit cost and also reducing on the on-balance sheet liquidity which would be there.
Right, and in terms of asset quality, during the pandemic, various asset classes had some pressure. Going forward, what would be the key monitorables, and would there be any specific asset classes where you see the pressure of the pandemic continuing?
Yeah, so on the asset quality, definitely the pandemic had its dent on the asset quality. There were certain segments which got impacted on a larger extent, like commercial vehicles, two-wheelers. These were the areas where there was a larger pandemic impact.
Right.
And also the government came out with multiple schemes of restructuring and ECLGS, where we see the restructuring supported book for top 10 NBFCs would be around 2%. And also the ECLGS supported book would be 5%.
Right.
So as the book moves out of from moratorium, definitely there could be some amount of slippages coming out from this segment,
Okay.
and which could impact the overall asset quality for NBFCs. Having said that, many of the NBFCs have provided a lot during the pandemic, where everybody has gone ahead and built their provisioning coverage, which would come handy when there could be some amount of slippages which could be coming from the restructured pool. As an India rating, so we have estimated that the GNPA for the sector on the NBFC side to increase from around 4.6% in 1Q FY23 to around 5% in FY23.
Okay.
And on the HFC side, it could again increase largely from 2.6% to 3% at the end of FY23. And many of this increase could also come in because of change in regulation, where we would be going on daily stamping basis,
Right.
where the NPA recognition would be on the daily stamping basis, which could have some amount of impact on the asset quality. But similarly, it could not have same impact on the provisioning coverage. So the credit cost would start normalizing in second half of FY23.
Right. Thanks, Jinay. While staying on the topic of asset classes, Payal, what would be the impact of pool performances of these asset classes in our rated transactions?
Yeah. So in terms of asset classes, as Jinay has mentioned, the collections and everything, they're coming back to the pre-COVID levels across asset classes. So we have rated commercial vehicles, unsecured paid, and lab segment. So in these are all back to pre-COVID levels. So collections are strong. Our pool performances has been strong. So in that sense, there's a good pool performance, because as I mentioned earlier, the pools are cherry pegged, and these kind of pools have given a strong collection performance in the first half as well. So so in that, and there we, and even the 90 plus in all these transactions are limited, and are back to pre-COVID levels.
Right, Payal. As a listener to the expert lounge, what are the key things that the listener would want to watch out for going forward?
Yeah. So see the few trends I think so to watch out for. That could be incremental slippages which could be coming out from this restructured book and ECLGS supported book, which would be ending its moratorium period in largely 2Q of FY23. So that could be the area which needs to be watched out for. Also with this rising interest rates, there could be some amount of skewing in terms of capital market borrowing for smaller NBFCs and even for larger NBFCs. So that could be also one more area point which could be more focused on. And also with this rising interest rates and also inflationary pressures building up on the borrowers end, that could be some amount of rise in the softer delinquencies. And controlling that at early stage remains quite focused for NBFCs. Otherwise, there could be again rise in the asset quality. And with daily stamping coming up, this could lead to be a higher number on the overall 90 plus numbers. So these are the few trends I think so any NBFCs should be watch out for in second half of FY23.
Payal, anything from your end?
Yeah, I think same as Jinay has mentioned, continued macroeconomic environment and inflationary pressure could have an impact on the repayment capabilities of retail borrowers. So if this continues, the pressure continues, could see the performance deteriorating in our pools as well. So that is something to watch out for. Otherwise, as the bank credit is picking up, we expect the DA and securitization route to expected to grow,
Right.
primarily to meet the PSL requirements.
Great. Thanks, Payal. Thanks, Jinay, for taking us through the outlook. This was really, really helpful. The link to the full report, which has been authored by Payal and Jinay, is shared along with the podcast. I highly recommend you have a look at it. But in the meanwhile, that's all we have for this episode of the Expert Lounge. It's a podcast brought to you by India Ratings and Research, because for opinions on risk and credit, India comes to us.